Okay, guys, so what we're looking at is the tax card that we started with at the very beginning. So let me just widen this out so we can all have the same view every time. Okay, so with the tax card, remember you're either going to assign the information yourselves, so you have a single person standard rate cutoff point in tax credits, so they're either going to be assigned to you or you're going to create them yourselves. So if you had to create them yourselves, remember you're going to take a portion of it every single week. So for example, if I'm looking at this section here, it is 42,000, which is a single person standard rate cutoff point, divided by 52. So there's one portion in week 1 and it's doubled up, so it's multiplied by 2 in week 2, 3, 4, 5 and 6 until you reach week 52, when you will have utilized your full standard rate cutoff point in tax credit. We're only using a basis here for the tax cards for the moment. The same with the tax credits. So the tax credits applied as per the instructions, whether they're single parent, married, depending what type of circumstances they're under. In this case here, it is 37,500, which is 1875, a single person's tax credit, and a PAYE or employment tax credit. So 3750 divided by 52, we have 7212 per week, and again doubled up in week 2, trebled up in week 3, 4 times in week 4, 5, 6 and so on. And when the employee will reach the end of the year, that's when they will have utilized their full 3,750. Every week then you apply the tax across the board, across from left to right every single week. So in this case here, €400, the cumulative gross pay is €400. You're comparing it with a standard rate cutoff point that you have been assigned. So either revenue have assigned it through an RPN, or you have devise it yourself, and in reality nowadays, revenue will devise an RPN, a payroll notification number, and a payroll notification details, which is the basis of every tax card. In this case, we have 400 which is less than the cutoff point, so all of the income is taxable at the standard rate, no income taxable at the higher rate, so €80 tax, less the tax credit from week 1 to give 788 tax, cumulative tax due, which is deducted, and so forth. So you work your way down the board. If you let's say if you started with €850, it would be different, because you now have a category here that is going to be different. The first thing you do is compare it with the standard rate, and in this case you can see here that the salary is greater than the cutoff, so therefore a portion of the income is going to be taxable at I'm just enlarging this, a portion going to be taxable at 20 and a portion going to be taxable at 40%. So how much is taxable at 40%? Well, we're going to take the difference between the gross pay and the up to the standard rate cutoff point, because that's what that means. It is a tax at the standard rate, and that's the cutoff when it stops. Okay, so we will have 4231 applicable at the higher rate. So over here then, and 4231 multiplied by 40%, and that's going to give me 1692. The biggest mistakes that is made here is taking the total amount of income at the standard rate. At this, because the gross pay is higher than the standard rate cutoff point, remember, we are applying income to 850, but a portion of it is going to be at 40%. So it's always up to this point that we apply the 20% ruling. Okay, so it's up to this point, multiplied by 20%, and that will give me the total tax. So to get the gross income, it is the standard rate plus the high rate due, and that's the amount of income tax that is now due, reduced by the credits, to give 106, so equal to 178 minus, sorry, that doesn't sound right there, I'm just going to go back and check that one. Is that correct? Multiply by 20%. That is, yeah, just seems awful high there for the moment. So we have 178.46 less the credit to reduce it, and that will give you 106.35, 106.35. So you have to, you have to look at your gross pay to date. So under the cumulative card, it is your cumulative income. I'm just going to get rid of those for the moment. So if we're looking at the next income at 650 added to the 850, and you're always working on the cumulative basis, so you've now back to a figure where it's less than the cutoff point. So 1500 is less than the cutoff point for this week. So we're not going to apportion it 40-20. We're just taxing it all at 20%. So I have to apply the rules, and make sure you apply the rules every single time. So that's 3. So reducing it then by the credit at that point, that will give 155.77. Compare it directly above. Remember that, guys. You're going to compare it directly with the one above it. Don't go on the skew edge. They're the weekly deductions. We're going to look at the weekly deduction or refunded here. And because it is greater than the previous week, there is a further deduction of the difference between this week's income tax due and last week's, which is 49.42. So the very basic rules, you've done them loads of time at this stage, but just remember when you're doing your projects, have a think about what you're putting in and the income you're going to tax, and at how much you're going to tax it. Is it 20% or is it 40%? Add the two of them together if necessary, reduce it by the credits, and give a tax due. Right, let's go back and start. If you had a very small figure over here, let's say we have 350 euro over here. So 350. Again, you're going to make some changes here because we're going to have a figure that is less than the cutoff points. All right, I wiped out the cutoff point there again. Let me just go back and put that in. Now let me just get rid of those for the moment. So if you have 350, it's way less than the cutoff point. It is still taxable. So 350 multiplied by 20%, and that is going to give me 70 euro tax. And in this area here, you will notice that the tax credits are greater than the cutoff, or they're greater than the gross tax, which means that there's nothing to reduce. So if your tax is less than your credits, it simply means zero. There are no tax to refund. These are non-refundable credits. If you don't lose them, you're going to lose them effectively. And if I was to continue to earn 350 euro throughout the year, I won't exceed my credits. So therefore, I probably will end up paying no tax for the whole year. So 140, and I have 144 to reduce them. Again, zero. So there's nothing going to change here. Again, 350. So equal to 1050 multiplied by 20%. That will give me 210. 210 income tax. And I have 216 to reduce it to 0. Don't be tempted to give a refund of those. They're non-refundable tax credits. So if I'm going to use them, or when will I use them? So let's say that I earned 500 the next week. I'm now up to 1,550, still under the standard rate cutoff point. What is my income tax on that at 20%? It is 310 euro. 310. I have now exceeded the credits, so now I'm going to start paying tax. So 310 reduced by 288.48, and that will give me 21.54, and that's the amount of income tax that I'm going to deduct this week. If I went back to earning 350 the next week, what would happen? So 1900 is the amount that is due at 20%. Okay, 19 multiplied by 20%. 380, so my total income is 380. But this time, you see, it's still greater, and I will have to reduce it. So even though up here for the first 3, because I was at the start of the year, I was able to accumulate them up. But now I have used up some of them in the 500 euro, and I am now going to go back to reducing it. So equal 380 minus 360. So that gives me 19, 20, 42. Up to the previous week, it was 21.54. So this is where I'm going to get a refund because the amount this week is lower. So it's a refund due. Okay, guys, any questions for me just before we move on from the cumulative tax? So what you need to know every week is, do I enter this in, or will the question be given to me? And I'll make sure you understand that when we go through the briefs, because you have a certain amount of tax cards to reproduce. So everything is okay under the cumulative tax. Okay, so moving on to PRSI. PRSI, as we know, is based on Class A contributions. You will have your booklet with the Class A contributions in it, and there is rules for employee and employer. Employer is very basic because it is either 8.8% or 11.05%. So guys, can you tell me, when do the 11.05 kick in? 441, exactly. So that's when once your income is less than, if it's 441, it is 8.8. If it is 441 and 1 cent, then it becomes 11.05. So you have to keep an eye on the gross pay every week in the column. Now I don't have a PAYE in this column. I'll have to look at the layouts, but it's either the gross pay, the single week's gross pay is what we're looking at. It is never based on a cumulative. The other thing we need to watch is the rates. So remember, guys, what is your rate? The first one is if it's less than 252. Okay, just let me put them in here. Pick up the pen. So if it is up to 352, it's at 0. There is no employee PRSI. If it's between 352.01 up to 424, remember it is 4%, but it has the PRSI credit. Okay, so that kicks in there. Anything greater than 424 is simply 4%. So realistically, that's what you're looking at for the employee PRSI. It's either nil, it is 4% with a credit, or if it's greater than 424 and 1 cent, it is just at 4%. Okay, so just remember the rules for that. Again, you don't have to learn these off by heart. You can just look them up, but be aware of what the income range is for that purposes. Just going to look at a calculation here that we have based on 395. So if I take 395 and multiply it by 4%, I'm going to get 1580. 1580. Just take this figure out not to confuse. So the next step then is to get the difference between 395 and 352.01, and that will give me 42.99. I'm getting 1/6 of it, so I'm taking this figure, dividing by 6. It's giving me 717. And that's what you use to reduce your 12 credit. And the 12 credit then, the remaining portion is 484, and that is used then to reduce the original PRSI calculation back to what we can offset off the employees. So again, just let's do it. So I'm just going to do it longhand. 395. So if there's a credit in it, 395, remember it's falling between 352.01 right up to 424. Okay, 424. So the next thing is 395 multiplied by 4% is giving me 1580. Then we have, that's the first step every time. The second step is to get the difference, 352.01. And the difference here is 42.99. We're dividing that by 6, and that's going to give 717. The third step then is to take the PRSI credit of 12, reduce it by 717, and the remaining portion then is what we're going to use to reduce this original charge. Okay, so that's what we're looking at, and as we said, that was 484, 484, and that gave a final figure of 1097 overall. So every single time that you do a PRSI credit, there's going to be 3 steps involved. The first one, calculating the PRSI as normal. The second, finding out how much of the credit we can use. So you do that in 2 steps. You're going to take the difference divided by 6, and then that difference is going to reduce the PRSI credit of €12 down to a portion that we can deduct from the original amount of PRSI to give us an amended PRSI if necessary. Everybody okay with that? Any questions on PRSI? Seem to be straightforward enough. Okay, and the last thing then that we looked at is USC, which is a tax card on its own, very similar to this. So every time you're going to look at the income that you have, and you're going to follow the cumulative cutoff point. So up to this point we apply 0.5%. Up to the next cutoff point we apply 2%. Then up to the next cutoff point we apply 4%, and anything greater than that we apply the highest rate of 8%. So let me take a high rate first. Let's put in €1,500. €1,500 is our gross income. So up to this point, up to 231, we're applying 0.5%. Does the income exceed the second cutoff? Yes, it does. Well, then the difference is subject to 2%, is this portion here. It's the difference between cutoff 1 and cutoff 2. So again, if I double click on this, that's actually the incorrect one there, because, sorry, now I'm just going to change that. First portion is all right. The second portion here is equal to 495 minus 231. The difference between cutoff 1 and cutoff 2, 264 at 2%. And just to avoid a bit of confusion, I'm just taking out the other calculations here so we don't see them for a moment. Okay, so the next portion then is we want to take the income between 495.38 cutoff point 2 up to cutoff point 3. So we're going to take that figure, which will give 851.62. That is going to be multiplied by 4%, and then the balance figures is at the high rate. So we're going to take 15 minus 1347, because we've applied up to rate 1, up to rate 2, and to rate 3. So the excess over rate 3 then is 153, and that is then multiplied out by 8%. In most events, we probably won't see the full 4 figures going in, but it is just to follow up on the actual calculation, just to refresh it there. So the amount we're deducting is 52.75. If I go again the next week, and let's say we have 1,400, going to add it. So under the cumulative rules, we're going to add it in every single time. 29, the first portion, so I'm just going to drag this down. The next portion is the difference between cutoff 1 and cutoff 2, and that's multiplied by 2% at 2%. Sorry, bring it down. The next portion then, are we going to exceed cutoff 3? Yes, we are. So this cutoff point is going to be used this time, and it will indicate that 1703 is subject to tax at 4%, and then we have the balance remaining at the 8%. So just let me bring down that. So what income am I looking at? I'm looking at 29 minus the third cutoff, and the third cutoff then will leave me with 206, and that's going to be subjected to 8%. Excuse me. So equal 206 multiplied by 8%. 1648. Then we add up all the the 4 deductions and make a comparison with the previous week, and there is a further 44.75 income USC deducted. If I was to go back to 450 the next week, let's have a look at that. So 2,900 plus weekly income of 450, giving me a cumulative of 3,350. The first portion is going to be at 0.5%. We are exceeding cutoff 2, so we have a balance in there multiplied by 2%. Are we exceeding the third cutoff? No, we're not. So which means the balance income, 3350 minus 1486.15 is calculated at 4%. There's nothing at the high rate, the very high rate. So the three elements there is 93.88, which is less than the previous week. So therefore we have a tax refunded in this week. So again, quite a bit of rules there for everybody to remember. So it's always based on, this is my total income up to this point. If I'm exceeding it, am I exceeding this point? Yes, I am. It's the difference between the two of them. Am I exceeding this threshold? No, I'm not. It's the difference between the income and threshold 2 multiplied by 4%. That's usually the general gist of it. So guys, anybody needs to ask me any questions in relation to the cumulative USC? Everybody okay on that? And remember, they can be transferred into the tax card. I generally transfer them into the tax card, but it will depend on our it will depend on the templates that when we get them, if that's in there or not. It might be just two separate cards. Any questions? Everybody okay? We're fine. Okay, so one of the things that we didn't actually look at, guys, and I just want to go over it now, or maybe we did, but I can't remember actually giving you practice on it. Just let me copy this out into a second sheet here. Okay, what happens then if I am over 70? So I'm 70 years old, or it didn't have to be 70. We'll just do another one. Okay, I'm working, but I have a full medical card. Okay, so if I have a full medical card, I get a reduced standard rate cutoff point. What it means is that I don't have any second cutoff or third cutoffs. I basically have a balance here at cutoff 2, and there isn't a third cutoff, so I'm just going to get rid of these here. Okay, so if I had income of 15, and again, let me enlarge the screen so we can look at it. So if we had income of over 15,000, and for some reason I had a full medical card. Okay, same principle applies here. So 15 is the income on which we're going to apply USC. 231.5% is 116, and then there is no second threshold. Effectively, it's the balance. So again, that element is taken out of it. There isn't another cutoff, and basically it is the income minus cutoff 1, and everything is at 2%. So if I had a full medical card, I only pay at the first rate and the second rate only. So there's no need to have a third and a fourth or a second cutoff point. I only need one cutoff point. Up to that point at a half percent, and then all the balance income is at 2%. Okay, so just to remember that when you have reduced income, reduced standard rate cutoff point. So if I'm the holder of a full medical card, okay, or if I am over 70, but my aggregate income, my total income, is less than 60,000. Okay, so they're the two circumstances where you can have reduced income. If you're a holder of a full medical card, or if over 70 years and your total income is less than 60,000, then you can have income tax payable at rate 1 and rate 2 only. Okay, the other thing to watch is what happens if I have a small income. Let's say I have 350 here. Okay, 350. Again, just let me pull out some of the rest of those figures so it won't confuse us. So if I have 350, the first 231 is at 0.5%, 115, 116. 350 is not going to exceed 495, so the difference here is 350 minus cutoff 1 to give me 119 at 2%, and the rest of that income is not needed, because I've just rate 1 plus rate 2, because my income is so low. The first portion and the second portion counts only, so 354. Again, if I went down 300, sorry, 300, again, you're going to look at your sorry, I'm going to go on cumulative there. So 300, which means I'm now on 650. Okay, so up to this point, and then the balance payment again. So you're just looking at up to 462.5%. How much is left? Equal to 650 minus 462. That will give me the amount left to tax, because it's not going over the second threshold. If it was to even go further, if it was to start with a lower amount, if it was to start, say, with 220 euro, well, what happens? It's lower than the first 231. So if it's lower than the first cutoff, it means all of the income that you are under the threshold one is calculated at least 0.5%. Okay, sorry, I didn't work that out. Multiply by 0.5%. So 110. So you're only taking the amount of income at 0.5%. It is less than the cutoff point. So there's a few different sections, and again, we're going to go through those and have a look at them. Any questions on those? No. Okay, so that is your cumulative. Everything is under cumulative. Your tax is cumulative. You can give a refund of tax if necessary. You're getting a portion of your cutoff points, your standard cutoff points, and your tax credits and cutoff points over a whole year. So it means if your income is high one week, you pay more tax. If it is low the next week, you will get a refund of tax, as we have here, or you may not pay any tax. It will depend. PRSI is on a week one basis. You're always going to look at the weekly income and see which class it falls under, A, O, A, L, AX, or A1. USC then is based on the circumstances that is provided to you in an RPN, and an RPN is a revenue notification, and it tells you to use these rates, the standard rates, then you have the opportunity to use those rates in that. So when it all comes together, you can work out your net take-home pay, as we have been doing. So that is our cumulative system in a nutshell. What works and what don't work, it will depend on our accumulated figures. Okay, so if we didn't register ourselves, and this is a big problem I see on forums and things at the moment, that maybe tax credits are wrong, people are on emergency from last year, don't know how to correct it. So it's really important that everybody would look at their tax credits, make sure that they understand what a tax credit is, how they can change it, how they can claim back tax, because this is the time for doing that over the last year, and it'll be open now after the 15th of January for review by everybody. So let's have a look at the circumstances that we apply emergency. The first thing is, when somebody's on emergency, they don't have a standard rate cutoff point, they don't have a tax credit. There's very specific rules regarding the emergency system for all elements of your tax and USC, but not PRSI, because PRSI will still always be on a week one basis. So if I am on emergency tax, okay, so I'm on emergency tax. Why am I on emergency tax? Can anybody tell me? If somebody was assigned emergency, why would they have been assigned emergency? Exactly. So for the first time, an employee have to register themselves. First time employee have to register. Okay, so they have to register with revenue commissioners. If not, they will remain on emergency. What other circumstances might somebody be on emergency? Exactly, Veronica. There's no PPSN, so they haven't brought in the PPSN number, so therefore it has to go on to emergency straight away. So a first-time employee, they have to register. If they don't register, there is no RPN. So what, so the no RPN means PN, it's a payroll notification number. Revenue won't be able to send one because they're not registered on the employment. If you don't provide a PPSN number, again, Revenue won't be able to provide an RPN. And therefore will have to go on emergency. So there's two very distinct areas where people have to go on emergency. So when you get your RPN, what do you expect to see on that? Well, you expect to see the standard rate cutoff point, and you expect to see the tax credits, and you also expect to see the USC cutoff points. Okay, so that's what happens when you get an RPN. So if you don't get an RPN, but basically you've no standard rate cutoff point, you've no tax credit, you've no USC cutoff points, and that means you must use emergency rules, and it's emergency without a PPS. So we're going to look at the two elements first. There's with a PPSN number and without a PPSN number. So remember the rules that applies. And how do I know what standard rate cutoff point? Well, it's always based on a single person standard rate cutoff point. And if I take that and divide it by 52, that will give me 807.69, and that is always rounded up to the nearest cent. So it'll give me 808. So sorry, adding that wrong, 808. So the standard rate cutoff point for 4 weeks only is 808. And let's say somebody starts here on week 6. I'm just going to move it down to week 6. So that is our first insurable employment. That's the first week of insurable employment. And let's say that they're going to earn, just cancel that pen out for a minute, says €500. So their gross pay is €500. It is non-cumulative. The first thing to establish, have they a standard rate cutoff point? Yes, if they've given the PPSN, you will give them 808 for that first week, which means the income tax is calculated at 20% only, because 500 is less than 808. So that is my €100. I've no tax at the high rate, and my gross tax is 100 plus 0, so 100. What is my tax credits? Again, just let me get rid of these for the moment. What tax credit have I available? Well, under emergency rules, there is no tax credit available. There's none. So I'm going to pay €100 in tax, and that's what's going to be deducted from me this week. The next week is my second week of insurable employment. I'm earning 500 again. Non-cumulative, remember. I have 808 for week 2, €100, 0, €100 tax, no tax credit, so my tax is €100. The next week I'm earning 550. 550, so it's non-cumulative. I still have 808, and I'm going to increase my tax slightly because it's a higher figure at 20%. €110, 0 high rate, total 0 tax credit, 110 deducted. Next week, let's go down to 450. Do we get a refund here? No, we don't, because it's non-cumulative. And again, I have 808 assigned because we're on the 4th week of emergency. So 450 is multiplied by 20%, €90. Again, if this was cumulative, you would be doing a comparison with what you have paid the previous week. But as it's emergency, it is done in isolation, and we're just going to do the 4 weeks as 4 separate sections. So in the 5th week of emergency, we're now on to week 10 of the tax year. But as we've only started it in week 6, remember, just to look at it, this is our 1st week of emergency, our 2nd week of emergency, 3rd, 4th, and now we're moving on to the 5th week of emergency. And let's say again that we're taking in €450. €450 non-cumulative. I have now utilised my 4 weeks of standard rate cut-off points. I don't have any left. So therefore, when I compare how much do I earn at 20%, I have nothing. I can't go back and look for the unused portion here. You never have a look back. It's an isolation, and it is always on what we call the week one basis. So 450 is the total amount of income due for the high rate. So again, you are increasing the amount of tax that you owe. 180 total tax. We have no tax credits, so therefore 180 deducted and 180 deducted. So you're using specific rules, really specific rules. If I was to do that without a PPSN, so what happens if you arrived, you are registered, but you can't remember your PPSN number? Well, straight away it's emergency without a PPSN, which means all of this income in the standard rate cutoff point is nil. So basically everything you will be taxing will be at the 40% rate rather than the 20% rate. So there is exceptions to it, and that's if you don't provide a PPSN number, you don't get a standard rate cutoff point. If you do provide it and you're on emergency, standard rate for the first 4 weeks you work, and then after that it's on to the high rate only. What happens then when you're transferring? What two figures do you transfer across to the cumulative card when you're ready to move on to cumulative, or revenue have assigned a cumulative card to you? What happens then? Tax paid, and what else? We haven't gone to that yet. What else should I take off my tax card? There's only two elements that I need. The amount paid, the amount that you actually paid out. So this is where we're going to accumulate. So they're the two things that we need to bring in, those two figures. So I have earned 2,450, okay, or the employee has, and they've paid 580 in tax. So when we go back to a tax card, you are going to slot them into the section. I'm just going to remove this. I'm using the one card just for illustration purposes here. So if I finished up on sheet 2, I finished up on week 10, the 5th week I start on week 10. So on the tax card I'm going to come down to week 10. What do I put in here? The gross paid to date. How much did I pay to date? 2,450. And after the tax credits, I find out how much tax was deducted from my emergency card, 580. So now I'm back to my normal element. So 500, now back to cumulative, I can be added. So 2450 plus 500 will give me 2950, compared with the standard rate cutoff point, all the income at 20%, and no high rate, and we're going to look at 590 tax. We have more credits than we have, so this simply is 0, which means we now owe 0 tax. This is the cumulative tax due. We don't owe any at this point because of the amount of income we earned and the tax credits that were not used up. So therefore all of this 580 can be refunded back to the employee, but only when you move to cumulative card, only when revenue tell you here's your cumulative. Have you noticed, guys, for the last few weeks in the income tax year and the first couple of weeks of this year, most people were reverted back to a week 1 situation? Did anybody notice that? If you're doing payroll, that's what happened. Revenue would look at, bringing everybody back to a week 1 basis. And what's the difference between revenues week 1 and emergency? I'll go through that in a moment, but it's something that they tend to do at the end of the year. And anybody working in payroll might have noticed that a lot of people that should be on cumulative have reverted back to week 1 for the moment until revenue are sure their circumstances are correct. Okay, so if I was working on PRSI on emergency, is there any different rules? Any rules for emergency PRSI? No, still the same. We're basing it on the income here at the moment, and if we're looking at that one, it would just be €500 multiplied by 4%. There's no PRSI credit on that one, so that was fine. No PRSI credit in any of those because they all exceed 424. And the same here with the employer. They're all over 441. So it's all at multiplied by 11.05%. Okay, and that leads us to the same calculation down along for the first two, changing down for the third, and then the same two for 9 and 10. USC then, guys, what is the rules for USC under emergency? 8%, yeah. So again, just let me bring out a separate card here till we look at it. So if I was on emergency, we don't have cut off 1 or 2 or 3. Okay, so they are not available to us. They're not available to us, so everything is calculated at the highest rate. And again, just let me take the sheets that we're using. So we have 5, 5. I'm just going to paste them in here. Copy, and we're starting on week 6. So week 6. Just let me get rid of those. So 500 at the 8% rate is what we're looking at. So there's no cutoff points. So everything, it means everything then is at the highest rate, which is 8%. So amount of gross pay liable for rate, the rate 4 is 500. And then we're going to multiply that by 8%. 8%. And that's the amount deducted. There's no cumulative, so equal to €40. So again, the same with the next week. So you move down your weeks, you find out what 8% is at each week, and there's no other specific rules attached to it. There's non-cumulative. Again, you can't give a refund. When you're transferring over then to the cumulative tax card, you need to take into consideration that we've done up to we've earned 5 plus 5 plus 5.5 plus 4.5 plus 4.5. We've earned 2450, and over here then we're going to add up the sorry, that didn't go in right for me. Equals sum. So 40 plus 40 right down along. So we're going to do a sum right to the end. Close off for brackets. That's not going to calculate that right for me. There we go. So €160. I just calculate it, and then I can continue then to do the next week and do a comparison. So very, very different rules for USC and tax in relation to emergency. The last one we looked at then was a week 1, month 1 scenario. So again, just let me take out a tax card and copy it out just so we'll have a look at it. So if you're using week 1, and this is the one we did just before Christmas, what are the scenarios? So you may be assigned a standard rate cutoff point for a single person, but it could be non-cumulative. It could be a week 1 method. Okay, week 1. Everything is week 1. Okay, so that's what we have to think about. It's non-cumulative. You work 1 week at a time, and only then when you transfer to cumulative can you seek a refund of tax, if any. Who would be placed on a week 1 section, guys? Can you remember? Not necessarily, no. Go again. So couple of scenarios. If it's your second employment, okay, your first employment is automatically assigned a cumulative with full credits. But if it's your second employment, revenue tend to put you on a week 1 basis. If you're moving from self-employment into employment, then revenue would not be aware of how much tax you owe to date, so they would give you a week 1 basis. So they're not going to let you claim back taxes if they don't know what you owe in taxes. So you only ever get a week 1 basis. Another scenario is when you're on illness benefit and you come back to work in the tax year, you're placed on a week 1 basis until revenue work out the taxes and work out the information due to you. Okay? So this, again, is very specific. So if this person here was on a week 1 basis, they would have 807.69 every week as a tax a standard rate cut-off point. Every single week would be the same. It wouldn't be accumulated. And the same over here, they would have 72.12 every single week, 72.12, and therefore that's the amount of tax credit they would have every single week. Again, let me just bring in a couple of calculations till we have a look at them. So if you had, say, €450, it's under the standard rate cut-off point for a week one basis. It's all taxable at 20%. Zero higher rates, 90. And again, we can reduce it by the tax credit. So equal to 90 minus 72.12. Sorry, I missed that. 70. The wire in the way here. 72.12. Okay, 1788. That is my tax deduction this week. If I earned less than that the next week, let's say I earned 350. Again, making a comparison, I've 808.69 this week, so all of the income is subject to 20%. No high rate, 0, and we have €70. I have 72 to reduce it by 72.12, so therefore it's simply 0. I can't refund any of those, so I have more than enough credits to cover my tax due. This week I owe 0. I don't make a comparison to see can I claim that back. I simply have no tax deducted from my wages this week. And it's up to every individual to log on to my account and look up the details of their tax liability at the end of the year. I'll show you. I'll log on to one later on this evening now, and we'll have a look at how you can claim back. Have a look at taxes. I do my daughter's because she worked in a few jobs, and it might be interesting to see have she any tax due back to her. Okay, so that is the week one basis. Every single thing is the same. When I transfer to a cumulative system, it may not be much of a difference because there is quite a high standard rate cut-off point and there is a tax credit every week. So it may not be a tax refund. It might just be a continuation under the cumulative system. Under week one, an emergency, there is no refund. You have to wait till the end of the tax year, or you have to wait until you're transferred to a cumulative system. Okay. For employee purposes, on a week one basis, absolutely no difference. So there's no different method for employee PRSI, employer PRSI, whether it is cumulative, emergency, or week one section. For USC, again, is there a difference with the USC section? Yes, there is. We take a USC card, and it is $231 every single week on the first cut-off. It is $495.38 every week on the second cut-off, and it's $1347 every week on the third cut-off. And again, there is no refund of taxes through a week one section until the end of the tax year, or until the revenue tell you otherwise. Okay, so 3 different methods, and you could be tested on all 3, guys. So that's what I want you to make sure that you know exactly what you're looking at. And when we go through the projects, which you're going to do in your own time and submit back to me, you're going to get a few different cases, a few different case scenarios, and you're going to do the tax, the PRSI, and the USC on all of them. On templates on tax cards. Okay, so you won't be getting those. We perhaps give them to you Wednesday evening. I'll get them all verified and up to speed, and get the main section of it given out to you on Wednesday evening, and we can work through them then, and I can look at them when I'm in Dublin then with you next week again. Okay, guys, any questions? Everybody happy enough with the 3 types of cards and the 3 different methods? If you have any questions, let me know. Everybody okay? Okay. Right, the next thing I want to show you is how to do, we're looking at the budgets, and we're going to do a year comparison, and we're going to go back to the annual question to look at how a married person can be taxed in 3 different ways. So what I'm going to do is I'm going to finish with this section here now. I'm going to finish the recording on it, put it up as a separate recording, and then we'll do a separate one for the basis of assessment for married people and a budget assessment. So just let me stop share for the moment and stop this video, and I will start a new recording.